Today I am going to explain about standard costing. So this is another technique in cost accounting which is used in taking the managerial decisions. In the last class we discussed about the marginal costing, and now this is standard costing. So what is the standard costing and what is the use of this standard costing? Here you should understood one more topic, that is called historical costing. What is this historical costing? Historical costing is useful only in taking the cost ascertainment. Cost ascertainment means deciding the cost, whether it is a direct material or direct labor or any other overheads. So only the cost will be ascertained in this by using this historical costing, means recording the actual cost that is incurred on direct labor or direct material or direct overheads. But our concern is to control the cost. So this standard costing is useful in cost controlling measures. How to control your cost is the most important aspect of this cost accounting. So in this technique of standard costing, we are going to control our costs. So how to control your cost? So for this, we need to take a standard cost. There is a difference between standard cost and standard costing. What do you mean by standard cost? Standard cost is nothing but an estimated cost or budgeted cost. So it is a planned cost. We call it as a planned cost. For example, I want to purchase material. I want to purchase 100 units of material at rupees 10 each. So this is my budgeted cost or my standard cost. Means each unit I want to acquire at 10 rupees. So that is my standard price. And I want to purchase 100 units, which is quantity, which is called standard quantity. So in this standard costing, the procedure is, the first one is setting standards. Setting standards. How much to purchase and what quantity to be purchased. At what price to be purchased and what quantity to be purchased. Standard price is the price at which we want to purchase that particular material, and the quantity we need to purchase is called standard quantity. So the second process is recording the actual cost. Recording actual cost. Here it is a budgeted cost and budgeted quantity which is set. Then the things will happen, will purchase the material and quantity. Here that is known as actual price and actual quantity. So at what price you purchased is called actual price, and actual quantity we purchased is called actual quantity. So the four important elements, that is standard price, actual price. Price is divided into standard and actual. Similarly, quantity is standard quantity and actual quantity. So here, setting the standards, recording actual cost, here actual quantity, standard quantity, actual price, standard price. The third one is, so already we set the standards, then we recorded the actuals and price versus quantity. Now the comparison of actuals with standard. With that we'll find the variance. This is the important usefulness of this standard costing technique. So initially we'll set the standards, we'll record the actuals, the quantity and as well as the price. We'll compare your actuals with your standards. Then we'll find the variance. Variance means the variation, your standards with your actuals. Accordingly, we'll calculate the inefficiency or efficiency of your budgets. So here in the planning stage, we kept this standards and actuals will happen, where comparison will be done, the variance will be found. This variance is a control measure where the variance will be calculated, either it is in a favorable way or unfavorable or adverse. So how? So we have the elements of cost such as direct materials, direct labor and overhead charges. When you come to this direct materials, here we'll calculate the material cost variance. Again, this cost variance is divided into two types, that is material price variance and materials usage variance. So what is the material cost variance? We'll compare the material cost. So what is your average cost and what is your actual cost and what is your standard cost? So the material cost variance is equal to your standard cost for standard quantity minus actual cost for actual quantity. How you will find this standard cost for standard quantity? Simply the standard quantity into standard price. So I want to purchase this much quantity with this price. This is my standard cost minus actual quantity with actual output, that is actual quantity into actual price. This is called material cost variance. Here MCV, material cost variance, is equal to MPV plus MUV, material usage variance. How we will find this MPV? MPV is equal to material price variance. The formula is actual quantity into standard price minus actual price. Using these four, you can calculate these variances and also you can find whether it is correct or not. The equation is material cost variance is equal to material price variance plus usage. Here you are finding the variance in your price. Here you are finding the variance in your usage, that is in quantity. So here MUV, material usage variance, is equal to standard price into standard quantity minus actual quantity. So by finding all these variances, whether it is favorable or unfavorable, we can find out. If your standard cost is more than your actual cost, so obviously it is favorable. And if your actual cost is more than your standard cost, because you failed in setting your standards, because your actual cost is exceeding your standard, which is adverse effect, means it shows your inefficiency. So what is the usefulness of this standard costing? Is the first one, the importance of this standard costing is, it is to measure the efficiency. It will measure the efficiency of the management, how they are setting the standards and whether they are reaching their goals or they are lacking. So they will measure the efficiency and they will fix the price. They can fix the price, and this standard costing technique is most useful to production departments, not to the job departments. Then it is also useful in cost reduction decisions. So all managerial decisions to control your costs will be taken in this standard costing technique, and which will reduce the burden of the management, means there is no duplication of the work, no need of historical accounting and all. So by using this standard costing technique, the managers can take the decisions in controlling the cost. So this is regarding the material variances. Similarly, we have labor variances such as labor efficiency variance, labor rate variance and labor cost variance and overheads. Not only this cost, also you can go for revenue. So revenue is the most important thing of sales. So even for sales also you can find the variances. So by going through notes, you can find all these various formulas to find the variances.